Welcome to the Motley Fool's Crunchtime series, where we scout out a single company from the story to the opportunities and risks. Let's take a look at one of the biggest brands in telecommunications, AT&T. First, my prediction. While the turnaround is working, I think it's very unlikely that AT&T stock will beat the market over the next 5 years. Now, I also think it's unlikely that investors will see the same sort of struggles that AT&T has had over the past 5+ years. All right, let's dig in. AT&T is one of the biggest wireless carriers in the US, as well as having a substantial business and consumer wireline service, high-speed internet, and a stake in DirecTV that it is, however, selling. Its businesses are largely mature, low growth, and in some cases actually declining a little bit, and its strategy is to milk the cash flows from those slowly declining businesses, make the most of its more steady ones, and invest where there's opportunity to grow revenues, market share, or improve profitability, and then return a sizable portion of that cash back to shareholders via dividends. The opportunity? It's really one of continued business improvements, lowering expenses, making the most of its cash cow businesses, and hopefully growing cash flows faster than what will likely be very modest revenue growth going forward. Like I said before, this is a large company in stable, mature industries without significant growth. This is still a little bit of a turnaround story. Management's already learned some painful lessons trying to buy growth in other industries. Its deal to sell off the remaining 70% of DirecTV that it owns is part of its opportunity to improve its business. The cash it earns from that transaction, which will be paid off across multiple years all the way out to 2029, should help it continue to reduce debt and bolster its balance sheet. The opportunity is really one that's more about finishing the turnaround and having a steady business, with a dividend yielding 4% at recent prices that should prove pretty safe, if not likely to grow at a very high rate. A decade ago, investors who bought AT&T thinking it would prove a safe investment learned a brutally painful lesson. Shares only very recently are up over the past 10 years. The dividend is about 50% lower after management went on a spending spree trying to buy its way to growth. The biggest risk? Probably current management forgetting those lessons instead of staying focused on the turnaround and making the most of a profitable core business that isn't growthy, getting caught up in empire building once again. There's also some valuation risk. Shares might look cheap at 5 times operating cash, but that's actually the highest it's been since 2017. Cash flows are also expected to fall in 2025. Now, my prediction, AT&T stock is up 72% over the past year and a half, while its cash flow multiple is up almost 60%. In other words, the market has moved the valuation higher more than the company's results have earned a higher stock price. Now, that's partly because the results have improved and expectations were extremely low. Nonetheless, I don't think AT&T is likely to be a market beater going forward, though it is more likely to be a consistently profitable investment and not the value destroyer it was for much of the past decade. All right, let's wrap this up. At The Motley Fool, your comments make us all smarter. Please comment with your own research and insights about AT&T. Tell us what stock you want to see us tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy now.